the way every day goes.
This question asks us to draw a data flow diagram, DFD, for the current production cycle of ESR Textile SD and VHD. The purpose of the DFD is to show how information flows throughout the production process. We need to identify the external entities, processes, data stores, and data flows based on the scenario given. Then, we represent them using the standard DFD symbols. So, this is our data flow diagram, DFD. For the production cycle, begin with receiving a customer order and checking inventory. The company then prepare the bill of materials, request the necessary raw material, manufacture product, record employees' working hour, and finally package and store the finished good in the warehouse. This process ensures that customer orders are complete efficiently while maintaining accurate inventory, production, and accounting records. Now, let's watch our short video as a scenario for this diagram.
The production cycle begins when the sales department receives a customer order. The production department reviews the order and checks the inventory file to see whether enough finished goods are available. If inventory is insufficient, a production schedule is prepared to begin manufacturing. Next, the production department determines all of the raw materials required to manufacture the product. This information is recorded in the bills of material, also known as the BOM. The BOM acts as a complete list of everything needed for production. The storeroom transfers the pre-processed material to the production department. Manufacturing begins as worker and machine produce the goods. If additional material are required during production, another request is sent to the storeroom. While production is taking place, employees record the time they spend working on each job. This information is stored in the job time ticket file and sent to the accounting department to calculate labor costs and employee salaries. After production is complete, the finished products are packaged and prepared for storage. The goods are transferred to the warehouse, where they remain until they are ready to be delivered to customers. In summary, the production cycle ensures that customer orders are processed efficiently. It begins with reviewing the order and inventory, continues through planning and manufacturing, record labor costs, and end with packaging and storing the finished goods for the future delivery.
Question 5. Meet Sunrise Catering Service Sdn Berhad, a rapidly expanding medium-sized catering business in Melaka, renowned for premium corporate events and weddings. Recently, business has been booming, their clientele is growing, their workforce is increasing, and their booking calendar is always full. But behind this massive success, Mr. Harun is facing a major headache. Why? Because tracking transactions and managing finance efficiently has become a chaotic mess. The crisis peaks at the fiscal year end. Income from complete events is unrecorded, advance deposits are recognized too early, and utility accruals are missing. The accountant is overwhelmed by depreciation adjustments and past recording errors. Consequently, cash flow is critically tight because massive sums are trapped in unpaid customer debt. Facing fierce industry competition, Mr. Harun has ordered his management team to overhaul the current system and secure the company's financial stability.
First, we have prepaid expenses, also known as deferred expenses. These are assets that are recorded when cash is paid in advance for goods or service to use later. Why do we record this adjustment? It is to ensure that only the portion used up during the accounting period is recorded as an expense, while the unused portion correctly stays on the balance sheet as an asset. This prevents our asset from being overstated. For instance, if Sunrise Catering pays advance for a 6 month for their Melaka kitchen, they must record an adjustment to show only 1 month's rent as an expense for the specific period. Second is unearned revenue or deferred revenue. This happens when we receive cash before a service is performed or goods are delivered. Initially, this cash is recorded as a liability because we still owe the client the service. We make an adjustment to recognize revenue only when the service is fully performed. This ensures liability is reduced and revenue isn't prematurely overstated. Imagine a client pays Sunrise Catering a deposit for a wedding. At first, Sunrise record this as a liability. Once the catering is successfully delivered, an adjusting entry transfer that amount from a liability to unearned revenue. Next, we have accrued expenses. These are expenses that have already been incurred by the business but have not yet been paid or recorded. We record this to ensure that all liabilities and expenses are recognized in the correct accounting period, even if the cash hasn't changed hands yet. For example, think about the wages for staff working the final event of the month. Even if their actual payday falls in the following month, expense must be recorded now. This provides Mr. Harun with a realistic and accurate view of his total labor cost of the current month. Fourth is accrued revenue. This is the exact opposite of the previous entry. It represents revenue that has been earned by providing service but has not been billed or collected. So, the reason we adjust this is to completely record income for service fully provided, making sure the sales numbers are accurate before closing the books. Based on the scenario, Sunrise Catering completes a massive corporate event on the very last day of the financial year but hasn't issued the invoice yet. An adjusting entry ensures this income is included in the current year's sales where it belongs. Finally, we have depreciation expense. This is the systematic allocation for a long-term asset over its useful life. We do this to match the usage for a long-term asset with the revenue it helps generate over time. It keeps the asset values on the balance sheet realistic, accounting for wear and tear. For example, since catering equipment is used to generate revenue over several years, recording depreciation matches that annual wear and tear against the income produced each year, ensuring the balance sheet stays accurate.
Now, I will be explaining about the two key ways in which a well-designed audit trail can assist in verifying the accuracy and authorization of financial transactions. First, what is an audit trail? An audit trail is a record that shows every step of a financial transaction. It connects the source of document such as invoice or receipt, the journal entry where the record in the accounting system, and the general ledger in the main book of accountant. In our case at Sunrise Catering, there are some problems such as invoice do not match with the journal entries, some documents are losses, and the money received in advance is recorded as income too early. Here are the solutions that we come up with to solve the problem. The first one is the confirming accuracy. Every transaction from the source document to the journal entry and the general ledger is connected by a properly organized audit path. In the Sunrise scenario, the audit trails enable the accountant to go backwards from the ledger to the first invoice in order to determine if the error was a data input error, a forgotten transaction, or an illegal alteration. This will guarantee the detection and correction of duplicates such as an advance payment viewed as earned income early and omissions such as complete events that are not recorded. The second solution are the confirming approval. An audit trail records along with dates, who started it, who approved it, and who changed each transaction. The audit record may show if a recorded revenue entry was properly authorized based on the event accomplishment and not just advance payment, as different staff members record payments and sometimes miss the source of the document. For payroll expenditure, the audit trail can confirm that each payment fits with allowed time records and event level of staffing, enabling management in determining if increasing labor costs are more reasonable and appropriate with the quantity of events.
Assalamualaikum and hi, my name is Nur Adani Fatihah binti Ridwan and I'm going to proceed on how flexible budget could help Sunrise Catering manage this issue more effectively. Flexible budget is a budget that changes based on the level of business activity or output. This is suitable for Sunrise Catering because the company experiences fluctuation in the number of events which directly affect labor costs and supply costs. Flexible budget divides into two parts, which is fixed costs and variable costs. By using flexible budget, management can provide more accurate planning. Management can estimate the amount of labor, food supplies, and other resources required for busy and slow months since the number of catering events changes every month. This helps to prevent both shortage and unnecessary spending, ensuring that resources are used effectively while maintaining the service and a good quality. Furthermore, a flexible budget supports cost control and profitability. By identifying cost variance early, Sunrise Catering can easily spot unusual increase in wages or catering supplies and can take action quickly to reduce unnecessary spending. In addition, a flexible budget helps management compare actual costs with budgeted costs at the same activity level. This gives a fairer evaluation of performance and helps management to determine whether the labor and food costs are reasonable or too high. The increase may be due to excessive overtime, overstaffing, poor staff scheduling, or low employee productivity. Likewise, if supply costs are unusually high, the company can check for wastage or inefficient purchasing. In conclusion, a flexible budget helps Sunrise Catering improve planning, strengthens cost control, and make more accurate performance evaluations. This enables the company to manage its finance more effectively and maintain profitability even when the number of catering events changes from month to month.
The first goal is Sunrise Catering needs to prioritize profit growth to ensure the business continues to grow and be able to compete in the competitive catering industry. This is because stable and continuous increasing profits are important to help the company cover operating costs, expand the business, and face future economic challenge. Based on the given situation, the company is facing increasing salary and there are several errors in the accounting situation can cause the company's profit not be determined accurately and affect the effectiveness of financial management. Therefore, Sunrise Catering needs to improve cost control and ensure that all transactions are recorded correctly so that the company's actual performance can be monitored more effectively as mentioned in flexible budget. In addition, the company can also increase profits by controlling labor costs, reducing food waste, and increasing the number of customer orders through quality service. Management also needs to ensure that the price charged to the customer can cover costs and provide sufficient profit margin. This goal is important to help Sunrise Catering remain competitive because companies that earn good profits have more resources to improve food quality, improve service, and carry out promotions to attract more customers. High profit also allow the company to invest in more modern equipment and expand the business in the future. With this, Sunrise Catering is able to maintain a strong position in catering industry and ensure long-term business continuity. The second goal is Sunrise Catering also needs to prioritize the goal of controlling debt and maintaining strong liquidity to ensure long-term financial stability. In the catering business, companies often require loans or financing to purchase equipment, vehicles, to support their daily operating activities. However, if debt is not properly managed, high interest expenses will increase financial costs and reduce business profitability. To improve cash flow, the company can accelerate the collection of account receivable, implement strict credit terms, and require customer deposits before catering events. At the same time, the company must maintain sufficient liquidity to ensure it has enough cash to meet short-term obligations, particularly accounts payable, such as payments to supplier, payments to employee, and other operating expenses. In addition, careful monitoring of operating expenses will help control cash outflow and strengthen the company's liquidity position. The current situation shows weakness in the company's accounting system and financial record, including recording error, missing source of documents, and unrecorded expenses. These issues may result in inaccurate reporting of liabilities, including accounts payable, making it difficult for management to monitor the company's actual debt position and liquidity. As a result, the company may face difficulties in paying suppliers on time, which could damage supplier relationships and disrupt business operations. Therefore, Sunrise Catering needs to ensure that all financial transactions are recorded accurately so that management can make informed financial decisions. Effective debt management, proper monitoring of accounts payable, and maintaining healthy liquidity are important to ensure smooth business operation and enhance Sunrise Catering's long-term competitiveness in the catering industry.
I just had to let you know you're